So let's talk about SoFi Technologies. This stock was on an absolute tear, a real market darling. And then, bam! In just one day, the bottom completely fell out. So what we're going to do is unpack exactly what happened, and more importantly, we're going to look at the Wall Street war of words that seems to have pulled the trigger on this whole thing. So picture this, it's January 6th, 2026, and SoFi's stock just tanks. We're talking a 9.1% drop. Now, for a stock that had been on such a hot streak, this was a really sharp, painful turnaround. And that big drop? Well, that's the central mystery we're diving into.
So you gotta ask, right? How does a stock with all this momentum just suddenly hit a brick wall? And here's the thing. The answer isn't some big scandal or a terrible earnings report. Nope. It all comes down to a major disagreement between the very experts whose job it is to analyze these companies.
All right, so to really get what's going on with this reversal, we've got to look at the seriously conflicting signals coming out of Wall Street. I mean, get this. On the exact same day, you had major analysts looking at the exact same company, and they came to completely opposite conclusions. How does that even happen? Okay, first up, let's talk about the bull case. The optimistic side of the argument. Leading the charge here was the investment bank Barclays. They looked at SoFi and saw nothing but blue skies ahead, a clear runway for the stock to just keep on climbing.
So what was their reasoning? Well, Barclays was looking at the bigger picture, the whole economy. They saw what they called a favorable credit environment, which basically just means it's getting easier for people like you and me to get loans. And since lending is SoFi's bread and butter, that's a huge plus. On top of that, they were betting on the mortgage market getting better, which would be another big win for SoFi.
And they weren't just talking a big game. They put their numbers where their mouth was. Barclays slapped a $28 price target on SoFi's stock. But here's the real kicker. They actually raised it from their old target of $23. Now that's a really powerful signal. It tells you they thought the good times were far from over.
But hold on. Not everyone was popping the champagne. On the complete other side of this debate, you have the bear case. This was led by two other heavyweights, Bank of America and Goldman Sachs. And let's just say, they were pumping the brakes, big time.
Both of these giants had the same core worry. The price just seemed too high. Bank of America straight up gave the stock an underperform rating. That's basically them saying, hey, we think this stock is going to do worse than the overall market because it's just too expensive. Goldman Sachs was a little gentler, calling it neutral, but their worry was the same. All the good news, all that amazing growth, it might already be baked into the stock price. And just look at this. You can really see how huge this disagreement was. You've got Bank of America way down at $250, Goldman in the middle at $24, and then Barclays is way up at $28. We're not talking about a small difference here. This is a massive fundamental clash over what these experts think the future holds for this company.
And really, what this whole conflict boils down to is that classic Wall Street debate. Growth versus valuation. It's the big question, right? Is a company's amazing performance and all its future potential actually worth the high price tag on its stock today? So let's break down both sides of that argument.
First, you can't argue with SoFi's growth. It's just undeniable. And it's all powered by this really smart and effective business model. Think of it like this. They get you in the door with one product, and then they start offering you more and more stuff. Banking, investing, loans. Before you know it, you're deep inside the SoFi ecosystem.
So, is this strategy actually working? Oh yeah, absolutely. Get this. In a single quarter, SoFi pulled in a record 905,000 new customers. They just keep breaking their own records quarter after quarter, which proves that people are really buying into what they're selling.
And it's not just about getting more users. The money is following. Overall revenue jumped 38%. But here's the number you really want to pay attention to. That financial services slice, all the non-lending stuff, that part grew by an incredible 76%. This is so important because it shows they're not just a one-trick pony. They're successfully branching out beyond their original loan business.
Okay, so with all this fantastic growth, why on earth would anyone be worried? Well, it all comes back to that word valuation. Here's the deal. Even if a company is doing everything right, firing on all cylinders, its stock can still be considered expensive. It just means the price might have gotten way ahead of what the company is actually earning right now.
And the bears? They had the numbers to back up their concern. First, the stock was trading at 53 times its earnings. Now that is a really high number, and it suggests that investors are already expecting a ton of future growth. Second, the company had just raised $3.2 billion by issuing more stock. Now, having more cash is great for funding growth, for sure, but it also dilutes the value for existing shareholders, because now there are more slices of the same pie.
All right, let's pull back for a second. Let's zoom out. What does this whole battle over one company's stock really tell us about the bigger picture? You know, about investing in these kinds of innovative, super high-growth companies today.
When you really get down to it, this SoFi story is so much bigger than just SoFi. It's a perfect example of that core conflict you see in the market all the time. It's what happens when a company's incredible, jaw-dropping growth runs smack into some really tough questions about its price tag.
And that leaves every single investor, you included, with the ultimate question when you're looking at a company like this. Are you paying for the amazing things it's doing right now? Or are you paying a huge premium for a future that might already be fully priced in? And that, well, that's the billion-dollar question, isn't it?